Welcome to Talk Tickers. Today, we're diving into the Q2 2025 earnings for machine vision leader Cognex. And folks, they just delivered a quarter that really shows a major shift in how they're running the business, and Wall Street, well, they definitely noticed.
So let's just jump right in. The first thing you need to know is the market's reaction, right? The stock absolutely rocketed up, spiking over 12% in the pre-market as soon as the news hit. Now, that's not just a little good job pat on the back. That's the market screaming that something fundamental has changed in the Cognex story.
And you know what? The market was right. This wasn't just a decent quarter. It was a classic beat and raise. For anyone new to this, that means they didn't just beat the expectations for this quarter, they also raised their forecast for the next one. It's the 1-2 punch investors love to see, and it really signals that a turnaround in profitability, especially under the new CEO Matt Mosner, is officially underway. Looking at the hard numbers, you can see why. Cognex came in ahead of expectations on both the top and the bottom lines. Revenue hit $249 million, which is great, but the real story, the one that got everyone's attention, was the earnings per share, or EPS, hitting 25 cents. This is now their fourth straight quarter of organic growth, so we're starting to see a really solid pattern emerge. So what exactly was behind that huge pop in the stock price? Well, let's get under the hood, because the story here is all about margins and a serious new focus on cost control. It's a classic profitability pivot.
And here's the star of the show, the adjusted EBITDA margin. For the first time since the second quarter of 2023, it climbed back over that critical 20% line, landing at 20.7%. Now, management had basically drawn a line in the sand, saying that getting back above 20% was a huge internal goal. And boom, they decisively crossed it.
Look, this didn't just happen by magic. It was a very deliberate strategic shift. And the CFO, Dennis Far, put it perfectly. The new mantra inside Cognex is crystal clear. Growth for the sake of growth is over. From now on, it has to be profitable growth that generates real cash. And this number right here just shows you how disciplined they were. Think about this. They managed to grow their revenue by 4%, while at the same time cutting their operating expenses by 2%. That, my friends, is what we call positive operating leverage. It's when your profits grow faster than your sales, and it's proof that their new, leaner cost structure is really working. All that efficiency is fueling what you could call a fortress balance sheet. I mean, they're practically printing cash, with free cash flow surging. They're sitting on over $500 million in cash, and get this, zero debt. You heard that right, zero. That kind of financial firepower gives them incredible flexibility to invest in new tech, like their OneVision platform, and to handle whatever the economy throws at them next. Okay, so the big picture looks fantastic, but to really get what's going on, we need to peel back the onion a little and see where that growth is actually coming from, because it's not the same story across all their business lines. It's really a tale of two markets right now. On one side, you have logistics, which is just on an absolute tear. This is its sixth straight quarter of double-digit growth. But on the other side, you have the well-known weakness in automotive, which is still their biggest challenge. So the strength in logistics and factory automation is more than making up for the slump in auto and a slight dip in semi. So a leaner company is great, but that's only half the story. Where is the next big wave of growth going to come from? Well, management is making a big bet on a brand new platform to cement their tech leadership and open up entirely new markets. And that bet is called OneVision. This is a really, really big deal for them. It's a strategic move to add a layer of software and recurring revenue on top of the thousands of cameras they already have out in the field. It's all about making incredibly complex AI easy enough for a much, much broader range of customers to use. Think of it like this. The system takes a super complicated process and makes it simple. It connects the hardware on the factory floor to incredibly powerful AI in the cloud. The whole idea is to democratize this high-end technology, so you don't need a team of PhDs to use it anymore. And this isn't just some PowerPoint fantasy. It's already working in the real world. The CEO himself shared this story about a huge noodle maker in Korea that used OneVision to slash their error rates on packaging. This is the product in action, solving real problems for customers, and that's how they're going to win. Okay, so Q2 was a home run. But what about the next quarter? What are they telling us to expect? Well, they didn't just deliver a great Q2, they followed it up with a really confident outlook for Q3. Their guidance shows things are actually accelerating. They're guiding for revenue to grow around 9%, and for that EBITDA margin to expand by a massive 340 basis points. That's 3.4 percentage points. All of that implies earnings per share growth of about 35% year over year. The whole profitable growth story, yeah, it's playing out right before our eyes. And here's the real kicker. That guidance actually looks pretty conservative. Why? Because there's a one-time revenue boost from a medical partnership that isn't even included in those official numbers. On top of that, they basically told the market, don't worry about tariffs or new taxes this year, we've got it handled, taking some major risks right off the table for investors. All right, so that's what the company is saying. Now what's our take? Let's connect all the dots and figure out what the call here is. This whole thing really boils down to one key question, right? Was this amazing quarter just a one-time thing? Maybe a new CEO trying to make a big splash? Or is this the beginning of a real sustainable trend? Our view? We think this is sustainable. Management made it clear this wasn't a quick fix. It was a company-wide effort that's been in the works for months. This performance puts them squarely on track to hit their 2026 margin goals, maybe even ahead of schedule. So while the stock has already popped, we think the combination of that operational leverage, the fortress balance sheet, and the huge AI pivot with OneVision means there's more room to run. Our rating is outperform. This is not financial advice.